Already, it's time 10:30. Hello everyone. I am Yu Hua Tan from University of Florida. Today we are very happy to have another seminar for our VMAS seminar series. We are very pleased to have um, a very nice paper by Qifei Zhu and Clemens Scheim on currency management by international fixed income mutual funds. Um, Qifei, you have 75 minutes in total. And if anyone in the audience have any questions, please either type that in the chat box. I will bring that to Qifei, or you can just unmute yourself and ask directly if you feel that's more comfortable. Um, with that, let's get started. I will turn around the table. Qifei, the floor is yours. Please go ahead and start.
All right, thank you very much for having me. It's a pleasure to present this work in this virtual asset management seminar series. Being a big fan of the series, and both Clemens and I are very excited to get all the comments and feedbacks from the audience. Okay, so as the title suggests, this is a paper that looks at the currency management by international fixed income mutual funds. And let me motivate this paper by stating the obvious. That is, if you are a mutual fund that's, let's say, located in the US, right? Your investors are US based and they care about their US dollar consumption. But your investment is in foreign fixed income or foreign assets, then not only are you bearing the risk of the appreciation or depreciation of those bonds, you're also bearing the risk of exchange rate movements, right? If the foreign currencies in which those bonds are denominated in appreciate, then you have a better return. If those currencies depreciate, you have worse return. I should say that this is not a unique problem of US investors. This is metric. If you are based in Singapore, you invest in the euro market, you also bear the risk of exchange rate risk. But for our paper, let's take a US-centric view because that's where the data is going to come from. So how important is the impact of currency risk in managing international fixed income portfolios? As a case for illustration, let's consider Barclays Global Aggregate Total Return Index, which is the leading index for investment-grade sovereign and corporate bonds in global portfolio, right? In the past 30 years, this Barclays Global Aggregate Index have a monthly return of 47 basis points per month, and the standard deviation is 1.54 percentage point. At the same time, Barclays also offer a hedged version of the same index. So all the underlying securities are the same, but everything is hedged back to US dollar using 1 month currency forward. Okay, that hedged version of the same index has almost the same average return during the 30-year period, 49 basis points, but the standard deviation is cut by almost more than 40% to 86 basis points per month, right? So this illustrates how impactful or how important, how crucial currency management is if you have an international fixed income portfolio. So if I'm a manager of such a global fixed income fund based in the US, how should I go about managing my currency exposure? Right? Let's say my mandate says I should put most of my assets in bonds issued by foreign entities. Then there are basically two ways for me to manage my currency exposure. The first way is that I may pick US denominated foreign bonds or current local currency denominated foreign bonds. Right? For many sovereign countries and big corporations, even if they are in, let's say, Eurozone, they may offer or they may issue a USD denominated bonds in the US market or offshore markets. Right? So if as an investor, I choose in my portfolio a large chunk of USD denominated bonds, that sort of reduce my currency exposure right off the bat. Right? In fact, there's a very nice influential recent paper by Majori, Neyman, Sugar that shows that investors do have a strong home currency bias. They tilt their portfolio towards bonds that are denominated in their home currency, and in our case, USD. Right? But that doesn't solve all the problem because not all foreign issuers have both local currency and USD counterparts in their bonds, right? And in terms of corporate issuers, only the largest company in foreign market tend to be able to issue USD bonds. So you're constraining your investment universe. So at the end of the day, you still have a big part of the portfolio assets that are denominated in non-USD currencies. And the second approach you can take to manage your currency exposure is to overlay a portfolio with currency derivatives, for example, currency forwards, right? That very directly reduce, or if you want, increase your exposure to foreign currencies. And that's going to be the key focus of our paper. And yes, go ahead.
We have one question from Vikas on board. Why is the mean return not affected by hedging costs? And that's a point more related to your previous slide on the two index return differences.
Yeah, two things. One is that index return does not take into account hedging costs. So the index provider basically just take the forward contract, sort of at the face value. So that's why later on, it will be an interesting empirical question to look at the actual fund return if like compared to funds, one hedged, one unhedged. And second one, sort of tangential to that question, is that when you think about currency hedging, you should really think about currencies as a zero net supply asset. So roughly in a long time series, you should think about currency return, expected currency return as zero. So if we do not take into account the transaction cost. But that's a very good point.
So I have an unrelated question. I was thinking, what are the main reasons why you choose to focus on international fixed income funds versus international equity funds?
Yeah,
some of the question. Considerations will also play out in equity, in the sense that most equity is probably issued at local currency.
Right, good question. Very true that the consideration currency risks will also be a part of international equity portfolios. But in terms of how relative importance, if you think about how volatile the underlying security return is versus how volatile the currency return is, for fixed income, the rule of thumb is sort of 50% of your risk is coming from the underlying security, the bonds, and 50% is coming from the currency return. So that's why you see in the first example, by hedging out your currency exposure, the volatility reduced to almost half. In equity markets, the variability of equity return itself is so much larger, so that makes currency return lesser of an consideration. And later on, I'll touch on this point again. Seems like based on past literature and based on some of our own analysis, as a fact, international equity funds do not use nearly as much currency forwards or currency derivatives as do international fixed income funds.
Got it. Thank you.
All right. So I was talking that there are two ways for US-based funds to manage their currency exposure. One is through their holding and the asset denomination. One is using currency derivatives. And our paper, to our knowledge, is the first paper that put together a novel data set that both allow us to look at the asset denomination of those portfolios and the currency derivatives employed by these funds. And that allow us to have a complete picture of a fund's currency exposure, both through its underlying asset and through the currency derivatives. And that novel data set allow us to ask some very basic but important questions. For example, how prevalent is the use of currency derivatives among our sample funds? Like, do they use derivatives? If they do, like, what direction are those derivative positions and how large are those derivative positions, right? And then we can analyze factors that might drive the difference in funds strategy deploying currency derivatives. And those factors can be at cross-sectional level, like why different funds have different approaches, can be at time series level, right? So given a fund's average approach or strategy, how do they change in response to macroeconomic conditions? And that can be also at cross-currency level, because for a given fund, they need to hedge euro, they need to hedge Japanese yen if those are the exposure brought about by their underlying positions, why their approach might different for different currencies, right? And third point is that we can examine using actual fund performance, what are the consequences of currency management, right? That relate back to Vika's question. Of course, we see this illustration using Barclays index, but in actual mutual fund practices, they incur transaction costs. There are also operational risks. So do we see similar patterns using fund return in relation to their currency hedging or currency derivative uses? Okay, and what do we find in response to these three questions? First of all, we find that there's extensive use of currency forwards by our sample of global or international fixed income funds, right? About 90% of our sample funds use currency forwards, and forwards is the dominant type of currency derivatives. There is a small fraction of funds that use options or swaps. And on average, the hedge ratio, which is the amount of foreign currency forward a fund sells divided by the portfolio weight of foreign currency denominated assets, that hedge ratio is on average about 20%. So that's a significant amount. And not only that, there's huge variation across different funds in terms of how much foreign currency forwards they buy or sell, right? On average, they hedge 20%, but some of funds will hedge all the way to 100%, and some of funds will actually have a negative hedge ratio in the sense of they purchase additional foreign currencies using forward contracts. We then examine the drivers of currency forward use, and we group those drivers of determinants into three groups. The first group is risk management. That's sort of most intuitive when we talk about currency hedging, right? So in that sense, when funds have more foreign currency exposure, when those risks is more concentrated, and when those foreign markets are more uncertain, we find that funds tend to hedge more using forward contract. There's also the speculative demands or performance enhancing motive, right? If there are some currency characteristics that can predict future currency movement against US dollars, then it will be smart for fund managers to at least adjust their forward positions according to that. If I expect some currency is going to appreciate in the future against US dollars, maybe I shouldn't sell as much currency forward in that specific currency, right? And the third group of motives or factors affecting currency forward use is strategic motive specific to mutual fund industry. We'll be looking at how fund managers adjust their currency forward positions in response to recent fund performance and in response or in relation to the fund clientele, institution versus retail. And finally, we're going to examine the performance consequences of currency management. And we find that during our sample period, which is 2010 to 2018, funds that hedge their currency exposure exhibit lower risk levels, but do not underperform. In most measures, they actually outperform. But we want to interpret that result with caution because this is a sample period where US dollar have appreciated significantly against foreign currencies.
Qifei?
Yes.
We have one question from Jerry Gay.
Yes.
To what extent do managers recognize the diversification benefits from having exposures to multiple different currencies? Does just need to, hedge the residual risk, or are their exposures typically concentrated in some particular currency?
So my understanding of our sample fund is that most of them have a quite diversified portfolio. I say that because the most common benchmark they use will be the Barclays Global Aggregate Index, which is just a value-weighted portfolio of investment-grade bonds with some additional filters. Okay, but I think this question is really it's a very good question because precisely we will have a determinant variable that we can test, which is the concentration level of foreign currencies. So for two funds with the same level of foreign asset or foreign denominated asset. If the first fund, the foreign currencies are coming from a small number of countries, so more concentrated, then we actually will find that this fund tend to hedge more of the exposure. So I think it's getting to the same point where Jerry was asking, risk management is more important if you have a concentrated exposure to foreign currencies.
Great. I also have a question.
Mhm.
Given that the currency risk is so important for the funds in this space, I'm curious to know whether in the prospectus of those funds, are there a lot of heterogeneity in terms of the mandate, how they handle currency risk? You know, some
Right.
is allowed, some just by principle they want to hedge most of it. Some will allow the manager to have more room and engage more in speculation. And have you checked on that to see whether that also played a role in explaining the heterogeneity in the use or the extent of which these currency derivatives are used?
Yeah, that's a very good question. Later on, I will show you two examples, two funds, where one fund in the mandate is clearly shows that it commits to fully hedge its currency exposure. The other fund, if you read the mandate, it sounds like they give the manager quite a bit of discretion in how they use currency forwards. And in those two examples, obviously, I show you'll see that our data agree with what the funds are doing what their mandate says they're doing. We are in the process of more systematically collect, not really the mandate, but the benchmark they use. And naturally, there are benchmark that's designed to be fully hedged, and there are unhedged benchmark. And my impression from initial analysis, which are doing that, is that there are about 10 to 20% of funds that have a fully hedged index, and those are the funds. I'm sure if we further read their mandate, they commit to fully hedge, and that's what data is saying. And then the rest of the funds, the majority of funds, have more discretion in they use an unhedged benchmark, and their mandates use language that give managers discretion. And those are the funds that, at least in our analysis, the more interesting time series or cross currency variation is going to be coming from.
Got you. Okay.
Yeah.
Thank you.
Okay. So let me our paper relates to several pretty big literature, so I will not dwell on this too much. Let me just point out one thing. There is a sort of old consensus in mutual fund literature that mutual funds tend to not use derivatives too much, right? If you read this paper by Koski and Pondiff on JF, they sample a cross-section of domestic equity fund, and they find that only about like 20%, less than 20% of funds use any type of derivatives. And then there's a survey paper by Levitch and co-authors that look at international equity funds in institutional investor space. And their conclusion is that very few of them use currency derivatives, okay? But our paper shows that there's a significant distinction between equity funds and fixed income funds. And our sample of global fixed income funds actually use significant amount of currency derivatives, meaning currency forwards, in both directions. So if you lose that part of exposure adjustment, and if you only take the asset currency denomination at the face value, then your measure of the ultimate fund currency exposure will be very much noisy or off the point. Okay, so that's the only comment I'm going to make here. So let's talk about the data and our sample and summary statistics. We collect data on actively managed international fixed income funds in the US. So those are all US domicile funds. And our assumption is that the investors are also mostly in the US. They care about USD consumption, okay? From 2010 to 2018. The reason we started from 2010 is that for the holdings part, we're using CRISP mutual fund holdings database, and that's only become more reliable after 2010. In that holdings database, each position has a CUSIP number, and then we then match the CUSIP number to information provided by S&P Global. So for each CUSIP number, we know the issuer's country domicile, and we know the currency that security is denominated in. So that's the holding side of our data, right? So that sample from 2010 to 2018 consists of roughly 300 unique funds, and in each cross-section, there are about 200 funds, right? And these funds collectively manage about $250 billion worth of assets, and you see it sort of grow quite relatively quickly in the beginning of sample and sort of plateaued and declined a little bit. Okay, in the later half of the sample, actually there's a quick growth of passively managed international fixed income funds, but those funds are not included in our sample. In the middle column, you'll see that at each year end, what is the percentage of our sample funds that use any kind of currency forwards disclosed in their filings, right? And consistently, about 90% of those funds use currency forwards in some fashion. And that's much more larger than the percentage of our sample fund that use either currency options or currency swaps. So because collecting the details of those derivatives is very time consuming, so we will not collect talk about, or we did not collect the information on currency options and swaps, but rather we'll focus the data collection on currency forwards. We'll do several robustness checks to ensure that not including the option positions will not affect our result too much. So what does the disclosure on currency forward look like? Well, each quarter from NQ filings or the NCSR filings, the shareholder report, you'll find contract by contract disclosure of all the currency forward contract a mutual fund engaged in as of the quarter end or as of the reporting date. So here is an example of the JP Morgan Emerging Market Debt Fund. And you can see that in each row corresponds to a particular currency forward contract. And for each contract, the following information is available. First of all, what currency it is this contract is purchasing and what currency it is selling, right? For a forward contract, you promise to buy certain currency in exchange for another currency at a pre-specified rate. So for example, in the first row, this JP Morgan fund is committed to buy additional amount of Australian dollar and sell a certain amount of US dollars. So this will be a transaction actually further increase this fund's exposure to Australian dollars. Okay. In the later half of this page, you'll see majority of the contract here is purchase US dollars and sell some foreign currencies. So that is more consistent with what we when we say currency hedging, that's selling a certain amount of foreign currency and convert them back to US dollars. Okay. And some additional information is also here. For each contract, there's a counterparty, that's a bank, and there is a settlement date, a maturity date of that forward contract. So note here that this filing is reported on May 31st of 2018, and for all those contracts, it matures or expires in about 3 weeks. And that's a general feature of forward contract used by mutual funds. That is, they tend to be quite short horizon, right? It's the average time to maturity as of the reporting date is a little bit more than 1 month. So even for those fully hedged mutual funds, they need to constantly roll over their currency contracts. So this raw information, which took us a lot of time to collect and also homogenize across different funds, is at contract level. But our analyses will be mainly at the fund quarter level. So we need certain level of aggregation. So what do? We first net out for the same foreign currency, for example, Australian dollars. If we observe for the same fund quarter, a fund is both buying Australian dollar and in exchange for USD and selling Australian dollar in exchange for USD, we net out those buys and sells. And we define our variable forward such that a positive number of forward would mean this fund is selling foreign currencies. So that's what you should think about hedging for a shorthand, right? And then we can aggregate again over all non-USD currencies that this fund enter into forward contract with. So across, we aggregate across these funds, selling of Australian dollars, it's selling of euros, it's selling of Japanese yens. So we arrive at this fund quarter net forward sales number. And that's gonna be one important dependent variables that we'll be looking at. We also define another dependent variable called hedge ratio. That's basically the ratio between the amount of forward contract or forward currency contract a fund sells divided by the portfolio weights denominated in foreign currencies, right? So if for a fund that sells 20% of its TNA worth of forward contract, it may mean different things if the exposure to begin with from the currency from the asset denomination is 20%, right? If I have 20% of denomination, currency denomination, and I sell 20% of currency forward, then I'm hedging out 100% of exposure, right? But if I have 100% of my portfolio denominated in foreign currencies, and I sell 20% of forward, then I'm only hedging out 20% of my exposure. And finally, we can also construct this dependent variable exposure at fund quarter level. And this exposure variable will take into account both the fund's asset portfolio weight denominated in foreign currencies and how much foreign currency forward it sells. So as I said, because we have both pieces of information, that allows to have the more precise measurement of the currency exposure a fund has.
Qifei,
Yes.
we have a few questions from Vikas. The first one is why there is a decline in the use of currency options and swaps over time, more so for options than swaps. And that is, I think, a comment on the table you showed on in the previous slide. Do you have any intuition why that is the case?
Frankly, I do not. One thing is that in the earlier part of sample, we have a smaller number of funds, and to the extent that there are some larger funds that use all kinds of derivatives and they survive throughout the sample period, maybe that's why the percentage turn is a bit higher in the beginning of our sample, but I don't have a very precise answer why that's happening. I'll look into that.
And he has a follow-up question. Why are there offsetting forward contracts in those holdings with the same settlement dates? So why you're buying and also selling Australian dollars with the same settlement dates? What exactly are they doing?
Yeah, my understanding is that's precisely when they are canceling their previous trade, right? If you enter into a forward contract saying I buy Australian dollars, and then later on you change your mind or you don't want to do that anymore, right? You don't wipe out the previous trade, but rather you enter into a opposite direction trade with the same notional amount and same settlement date. That's just the way they close out their trade.
I see. So if that's the case, do they have to like do a round trip, do an offsetting contract for all of their exposures? No, or some of them? Yes.
No. Only if you don't want to have that open exposure to the currency anymore, right? If you want to keep having the exposure to Australian dollars, then obviously just let that forward contract settle.
So Qifei, sorry, so I think you could test for the first point, you could actually look at the funds which you keep the fund constant, and you can see if the same funds actually change their option usage over time. So it could be you could test your hypothesis that you mentioned. So that's about the first point. About the second point, I think these offsetting contracts are kind of interesting because, I mean, that seems like you make mistake or something. Like you can't be doing that many mistakes, right? Like you can't be changing your mind that often, or so what is, so I'm wondering like how the results would be different if you were to actually exclude these offsetting contracts and looked at the ones, like what is the percentage of holdings which are like of this nature? I'm just curious, like.
Right. If you go to the previous slide, if you could, I think Australian dollar is the one you see offsetting trade. Others is just mostly, oh, the first few you see.
No,
all-
even the USD Indian rupee is also offset.
Right.
Right. I should clarify. It's not necessarily you made a mistake, right? You enter into a bet. Let's say you think Australian dollar is gonna appreciate, so that's why you purchase Australian dollar in exchange for USD. At a later date, you see the Australian dollar has already appreciated, and the spot rate and forward rate have adjusted, right? And you don't think Australian dollar is going to keep appreciate, so you sort of close out the trade by selling Australian dollar and buying USD at the forward rate at that later date, right? So your first trade was right and you have made money, but then you don't want to have the exposure anymore going forward.
So you're saying
That's
that
why
the entry date is different for those offsetting contract, but the settlement date is identical. That's one.
Right. One thing that's very unfortunate from a data perspective is that they don't disclose the entry date.
Yeah, so that's okay. So that's an important part, right? Because so in some sense, like these offsetting contracts also give you an insight into how dynamically they are actually doing this hedging. So like
Right.
why are certain funds, so presumably like funds which have similar kind of exposure should actually behave in the same way, you would think, right? I mean, if suppose they all see that the exchange rate moves in a certain direction, then wouldn't you expect like all the guys to be doing the same thing? Like why are some guys not offsetting and while some are? That's what I'm trying to understand.
Right. We could do more on the contract level information, but yeah, but as I said, one unfortunate feature is that we do not know the exact date they enter the contract. That sort of limited our knowledge on like how much have changed since they entered, like between the time they entered and the disclosure, and then eventually matures. But that's a very good suggestion and comments you were giving. Yeah. So those will be our important dependent variables. And let me show you the summary statistics of these funds.
One last question, Qifei.
Yep. Go ahead.
I was curious, what is the RT in the hedging ratio formula, the RT in the denominator?
Right. So because the forward contract, so let's say you have $100 worth euro worth of position, and you want to fully hedge it, right? But because the forward contract is contract a notional value on a future date,
I see.
so you have to adjust the interest difference between today and that future date. In practice, that adjustment is not important because the forward contracts are super short term. It's like 1 month, 2 months in our sample.
Only adjusting the difference between May 31st and June.
That's right.
18th, a few weeks.
That's right. That's right.
I see.
Yeah. So that's why there's this small adjustment. Okay. So summary statistics. Precisely speaking, 87% of our fund quarter has used currency forward in some fashion. Okay, and an average fund in our sample have about 78% of their portfolio issued by foreign entities, but only 42.8% of their assets denominated in foreign currencies. So if you think about how they adjust their currency hedging and what's the first approach that the picking currency denomination versus the second approach using currency derivatives, this 42.8% is sort of the starting point. Okay, and in terms of how much currency forward they buy or sell, an average fund sell about 20% relative to the TNA worth of currency forward, but at the same time buy about 13% relative to TNA worth of currency forward. So they're doing the currency forward trade in both directions, both selling foreign currencies and buying foreign currencies. So on a net basis, the forward position reduce the foreign currency exposure of an average fund by 6.8%. And in terms of hedge ratio, the average hedge ratio, as I said before, is a little bit less than 20%. So 18.7% of the asset denomination exposure is reduced or is canceled out by the sale of foreign currency forward.
So Qifei, I have a thought just related to what Vikas brought it up. So those offsetting, is it more they're doing speculation? If you really want to hedge, unless your underlying asset has like a structural change or a big shift in terms of their like foreign currency, otherwise you wouldn't be expecting, right? If some funds just want to be fully hedged, you probably won't see those offsetting contract often. So I'm thinking that could be something you can construct a measure on the activeness of currency speculation.
Yeah, very good suggestion. Thank you for that. Yeah. Okay, so now that we've seen this sample averages, let me actually show you two examples of what funds might do in terms of their currency forward use. And these two funds will be like the polar example of our results. The first fund is the DFA Global Fund Portfolio. And if you read the prospectus, it says this portfolio is designed to provide a currency hedged global fixed income instruments maturing 5 years or less. The currency exposure associated with non-US dollar denominated securities within the portfolio is generally hedged back to the US dollars. So if you read the prospectus, seems like this fund is committed to have fully hedged portfolio. And we set out to do this analysis because one, we want to know whether this fund is doing what it's saying they are doing, and two, want to know our data quality, right? If we're collecting data the right way, then it should reflect this fully hedged practice. So we're right on both ends, right? This fund is doing what they're doing, and our data is relatively reliable. So below in the figure, you should see in the white dot, the circled line, that's the portfolio weight of assets denominated in non-US USD currencies, right? And you see it fluctuates throughout the sample period. And the solid dot line is the amount of foreign currency forward this fund sells. And you can see the solid dotted line tracks the circle line almost perfectly. In the quarters when this fund have more foreign currency assets, it also sells more amount of foreign currency forwards. So as a result, the cross line, which is the net foreign currency exposure, which is difference between the foreign currency holdings minus the foreign currency sales, that cross line is almost constantly zero throughout the sample period. So this fund is fully hedged, and our data support that. And by the way, those type of fully hedged fund, as my answer, I was answering Yuehua earlier, these type of funds is only the small fraction of funds. Like fully hedged fund is at most, I would say, 15% of sample. We're still putting together the benchmark data, but these are the small fraction of our observation. The more common type of mutual fund, if you read their prospectus, seems to give their manager quite a bit of discretion in how much and what direction they can use foreign currency derivatives. So this is an Oppenheimer International Bond Fund, and prospectus says this fund actively manages foreign currency exposure, both to reduce risk and to seek to enhance return. To do so, the fund may invest in foreign exchange derivatives, including forwards and options that reference foreign currencies. So here again, the circle line is the portfolio weight for assets denominated in foreign currencies. In this case, it is kind of constant, 60%, 70%, right? And solid dotted line is the amount of foreign currency forwards the fund sells. And as you can see, the amount of forward it sells fluctuates from quarter to quarter, and there's no discernible pattern, at least in the time series. And as a result, the net foreign currency exposure, the difference between the foreign currency holdings and forward sales, which is shown in the crossed line, that's also fluctuating. So this fund in the time series, the manager display a lot of discretion in how much and what direction they enter their forward contract. And finally, to plot all the sample funds into one graph. Here, I have the x-axis as the portfolio weight of assets denominated in foreign currencies. The y-axis is the fund exposure to foreign currencies, which is the foreign currency asset minus the foreign currency forward sales, right? And there are several groups of funds that you can sort of figure out in this graph. The first group of funds sort of sit along this 45-degree line. And if you're on the 45-degree line, that means your currency exposure is similar or the same to your foreign currency asset portfolio weight. So that means on net, you're not buying foreign currency using forwards. You're also not selling foreign currencies through forwards, right? So these funds are they're unhedged, or as long as they use currency forwards, they offset each other, so there's no directional change. There are also a group of funds that sit on this horizontal axis, y equals 0, right? So these funds, regardless of their portfolio asset denomination, they have 0 exposure. Or these funds are those fully hedged DFA funds that they use forward contract to bring back the exposure back to 0, to convert everything back to US dollars, right? And then there are funds that sort of lie within this 45-degree line and the horizontal axis. These are the funds that partially hedge their currency exposure, and presumably they have some discretion. So here I'm showing every dot is a time series average for a fund, but presumably these funds' currency exposure also fluctuates from quarter to quarter. So that's the landscape of the cross-section of sample funds. They do very different things with currency forwards. Okay, so now let's go beyond stylized facts and do some regressions. We want to know what are the determinants, possible determinants of funds' different strategy using currency forwards. And as I mentioned before, we group those determinants into 3 bins. The first bin is the risk management. That's what you should think about when we say currency hedging, right? So naturally, in terms of currency management, how much of your portfolio asset is denominated in foreign currencies is going to be important, right? And as mentioned earlier by the audience, the concentration of those currency denomination will also be important in how much risk management you want to do. The second group of determinants is what we call speculative demands. You should also think of that as a performance enhancing motive, right? So if there are some currency characteristics that are known to predict future currency returns, then fund managers should adjust at least their currency forward positions in accordance to that. You don't want to be caught in a currency momentum or currency carry trade if you sort of hedge those foreign currencies too much. And the third group of motivations or determinants is the managerial strategic motive in relation to past fund performance and also to the clientele of the funds, institutional versus retail. So our first regression will be looking at the cross-sectional, mainly cross-sectional difference. So this is the panel data at fund quarter level. We control for time fixed effect. So sort of the main focus is on the cross-sectional difference. We look at both the extensive margin. So that's the first column. There's one dummy showing whether this fund is using any type of currency forwards. Also the intensive margin. So the continuous variable using OLS method. I will direct your attention to the second column. So the second column, the outcome variable is just how much currency forward this fund sells in a net basis, okay, and also relative to the TNA. And it turns out that when a fund have more assets denominated in foreign currencies, naturally it will sell more currency forwards. But there's a very interesting distinction between developed market currencies, which we term as G10 currencies, and developing market currencies, which we term other foreign currencies. So if you read the coefficient in the first row, if a fund have $1 additional asset denominated in developed market currencies, it tends to sell about 27 cents worth of currency forwards. So they partially hedge the exposure to those G10 currencies. But if a fund has one additional dollar asset denominated in emerging market currencies, the net forward sell is roughly 0. It's insignificant. Okay. when you talk to practitioners, they sort of confirm that this is what's happening. And the main reason is that for many funds that sort of invest in emerging market, they're in it for that country, they're betting on country, and they're in it for the high interest rate of this emerging market. So hedging back using forward, you're sort of giving out the forward rate, sort of defeat the purpose, okay? Because covered interest parity still roughly holds, although violations exist. Whereas for funds that mainly invest in developed market, the G10 currency market, there the investment strategy tend to be more nuanced. There are credit selection, right? The mutual fund invest in different corporations in those funds, and they also time the term premium. So for those more complex investment strategies in the developed market, it's nice for some of them to hedge the background, so to speak, currency risk, and focus on what they're doing. For example, selecting different corporate bonds. In the third row, we calculate the portfolio currency concentration using the Herfindahl-Hirschman index of the foreign currency in a fund portfolio. So there, holding the level of foreign currency portfolio asset constant, if a fund has a more concentrated currency risk, their exposure is coming from a small number of countries, then the amount of forward sales tend to be higher. That's when the hedging, so to speak, or risk management is more important for those funds.
Qifei?
Yes.
We have one question from Yixing that is related to exchange rate. So for a fund that does not fully hedge, is the net foreign currency exposure correlated with the exchange rate volatility in the time series?
We'll see that. The answer is yes. We'll see that, exactly that.
Okay. And we have a follow-up question from Vikas. Is currency hedging a fund level or a family level decision? The analysis seems to be rely that is at the fund level.
Yes, the analysis is at the fund level, and my belief is it is a fund level decision. The reason I say that is that if you look at those big houses like PIMCO, they have a range of funds, product offerings, and very clearly from the names you see they differentiate. They want to both have the hedged version of their funds and unhedged version of their funds. So I believe it's a very much fund level decision.
So, Qifei, let me. So I was thinking, yeah. So what you're saying is right, but I was wondering if there is some kind of decision that is made at the family level in terms of trying to minimize the hedging costs, right? Because in some sense, as you said, that they may be offsetting within the fund, they might also be offsetting at the family level. So suppose if you have multiple funds at the family level, I'm wondering like if there is anything that the family sort of accounts for overall in terms of how much they are. Otherwise, it seems like there is some kind of a duplication here, right? And some deadweight costs.
Yeah, I think, no, that's definitely right. And I think I can add 2 points. One is that there seems to be some economy of scale. If you look at our first column here, larger family tend to have more use of currencies at extensive margin, right? So that's consistent with like setting up this whole operation is costly, and the cost can be shared at the family level. Although that being said, 90% of funds use currency forwards, so that cost wouldn't be too prohibitive. I think there's a deeper point that you made that we haven't explored. That is, in terms of managing like counterparty risk, and perhaps there is some collateral agreement, then some sort of netting may be occurring at the family level. So if two funds are doing very different things, but the forward contract are at the opposite directions, that may be efficient for the family, because then the counterparty risk is not as large, and to the extent that they would post collateral, they can save some money. But that I'm just speculating. We don't have concrete data on that.
Yeah, no, I think I hadn't thought about that deeply, but I think that, yeah, you that's an interesting angle. I was also wondering if you, excuse me, if you look at the number of funds within a family that hedge, is the amount of hedging also dependent on that? So in this regression, for example, if you also did it at the family level and see if, if you had more number of funds, like how does that play out in the amount of hedging that is done?
Right. No, we can certainly explore that part. We haven't done that so far. Yeah.
Thank you.
Thanks. Yeah. So the last variable I want to direct your attention to in this table is in the last row. That's the fraction of assets for each mutual fund that's coming from institutional shares. And we use that variable to try to capture whether a fund is mainly sold to institutional client versus retail client. And our intuition is sort of from the Modigliani-Miller theory in corporate finance, right? If the end investor of a fund can access foreign exchange market themselves, then it doesn't make too much sense, or there's not too much value added for the fund to do hedging on the client's behalf, right? And the coefficient sort of is consistent with our argument. If the fraction of assets is mainly in institutional shares, indicating this fund is sold mainly to institutional client, then this fund tend to do less hedging, or tend to at least sell less of currency forwards. And presumably institutional client can do the currency management on their end and at a more centralized and then hence more efficient level. Whereas if a fund is sold mainly to retail clients, and presumably retail clients cannot access FX market very efficiently, then fund tend to sell more of a currency forward and have a higher hedge ratio. Another thing that we want to explore that relates to the strategic motive of mutual fund managers is that compared with the underlying asset, which is fixed income securities, not too liquid, currency contract seems to be a way for fund managers to change or switch their risk exposure very quickly. And that begs the question of whether they will strategically increase or decrease their risk exposure when they have, say, a period of poor return, okay? And if you're familiar with mutual fund literature, then tournament effect comes to mind very easily. And tournament effect says those trailing funds that have poor performance in the recent period tend to increase their risk exposure, hoping to swing for the fences and get more flow. But on the other hand, there are research, particularly in bond funds, that says if the underlying holding of the funds is illiquid, and then there was strategic complementarity between investors' redemption decisions, then what would happen is that if you have a poor performance and you keep delivering negative return, then your investors will have a bank run on you, and you'll have a catastrophic outcome in terms from the perspective of mutual fund manager, right? So if that's the case, then poor performing funds should really hedge more and reduce their risks to avoid the downside large redemptions. So whether in what direction the strategic response go really depend on the flow performance shape of our sample funds, international fixed income funds, rather that performance flow relationship is convex or concave. So we'll regress the fund flow on the negative part and positive part of style adjusted performance to get to know whether this relationship is concave or convex. And then we do the same regression on the currency forwards and see how this currency forward adjusts with past performance. We find that consistent with the literature on corporate bond funds, these international fixed income funds also have a concave flow performance relationship. That is to say, the fund flow is much more sensitive to negative territory or poor performance. If you have poor performance, you have large outflow. If you have good performance, the relationship is kind of flat. Okay, and in accordance to that, fund managers tend to increase their hedging, or in other words, reduce their risk when they have poor performance. So you should really be looking at column 2 and the first row, right? The coefficient is significantly negative. So if you have a period of negative performance, then negative times negative, you have a very positive, you have a large increase in the amount of currency forward you sell. And you sell currency forward, presumably that reduce your risk. Okay, so that's the strategic motive in relation to past performances. Next, we'll examine how currency forward use will respond to market conditions. And by market conditions, again, I'm thinking both in terms of risk management and performance enhancement, right? In terms of risk management, as pointed out by the audience earlier, it makes sense for funds to hedge more when the underlying riskiness of the foreign currency is greater. And we measure the riskiness of currency using both the realized volatility of the currency against US dollar and also a textual-based measure, uncertainty measure provided by Nick Blue. In terms of performance enhancement, there are large literature in the currency return studies that show that past performance of a currency can predict future currency performance. So that's currency momentum. And also short-term interest rate differential can also predict future currency returns. So that's currency carry. If we have those characteristics of a currency that says this currency, we believe will appreciate in the future against US dollars, then the rational thing for the fund manager to do is to reduce the currency sale or currency hedging it does with regard to that currency, right? You don't want to be caught in the wrong direction. So we'll explore that too. So we'll rerun our panel regression at fund quarter level, but this time we're controlling for fund fixed effect, but we are not including time fixed effect because the main independent variable will be varying only at time series level, right? So holding fund average hedging strategy fixed and see how the marginal adjustment go in relation to macroeconomic conditions. And what do we find? We find that following a period of high foreign currency return relative to USD, funds tend to reduce their hedge ratio. And presumably that's consistent with a currency momentum strategy. If you see foreign currency have performed well, you believe they'll continue to outperform or appreciate against USD, you scale back your currency hedge, right? On the second row, we see that following a period where the average foreign interest rate is higher than the US interest rate, funds tend to lower their hedge ratio. That's potentially consistent with carry trade because carry trade tells you that's a violation of uncovered interest rate parity. If a country have a higher short-term interest rate, the currency tend to appreciate again, continue appreciating in the next period. And if that's the case, the rational thing to do for manager is to scale back their hedge. And finally, on the third row, we find that during periods where the uncertainty is high, using World Uncertainty Index, the hedge ratio of a given fund tend to be higher relative to its time series mean. Okay, so that's consistent with the risk management motivation.
Qifei, we have
Yes.
A comment from Vikas.
Yes.
It may be helpful to repeat the hedging analysis with respect to past performance separately for retail versus institutional client. Wrong behavior may be different for different clientele.
Right. Okay. Yeah. No, that's a good suggestion.
And I mean, a related thought I have is, I mean, the capital fragility argument really relies on this illiquidity of the underlying assets. I was curious whether you can, add somewhat an interaction term to see that it also plays out in your sample. Right? When the underlying asset is more illiquid, then you see a more concave, and also this hedging is also affected. They have strong incentive if exactly that their online assets are illiquid. And those could be the non-G10 currencies. I was curious whether that will show up because those could be the most illiquid from my guess.
No, that makes perfect sense. We should, we'll definitely try that. Thank you, both you and Vikas.
Right. And another thought I have on this table is if data is there, you could do a currency by currency analysis rather than using average, right? So that you will have a fund times quarter fixed effect. You're exploring within fund quarter across currency. That result is going to be stronger and more convincing if you could do so.
Great. That's exactly where we're going in the next slide. Very good observation. Okay. Yeah. So as Yuhua correctly pointed out, we can actually fully utilize the granularity of data in terms of we can expand the firm quarter observation to firm currency quarter, right? For the same fund, fund currency quarter. So for the same fund, if it has exposure to, let's say, euro versus and Japanese yen, then its hedge ratio may be different for euro and Japanese yen. And the nice thing here is that we can control for fund by quarter fixed effect. So that's basically just saying this fund have a baseline hedge ratio of 20%, right? But it may hedge euro more, may hedge Japanese yen less. Why is the difference? Whether this difference is correlated with currency characteristics, we can explore in this expanded setting. So again, it's the panel, and the structure is fund by currency by quarter, and we're controlling for fund by quarter fixed effect. So really the variation is coming within fund across different currencies. Okay, so if we focus on the first column, the hedge ratio, we find within the same fund in the same quarter, the hedge ratio tend to be lower for the currencies that have a higher recent return relative to the US dollar, right? Again, consistent with the momentum strategy. Similarly, within the same fund quarter, the hedge ratio tend to be lower for currencies that has a higher short-term interest rate. So that's the carry trade component. The third and fourth row shows you relative, comparing the Japanese yen and euro in our previous example. If this currency have a higher past volatility or the country-specific uncertainty index is high, indicating high uncertainty again in that specific country, then the hedge ratio will be higher even within the same fund. Okay, so this is really the beauty of our data, that we can even open up the hedging operation for the same fund, but with respect to different currencies. And to the point of this heightened uncertainty, we also do an event study using this data structure. That is, this event is the Brexit referendum that took place in June 23rd, 2016. And needless to say, that was an event that induces a lot of uncertainty on the value of British pounds. So we can compare a fund's hedge ratio on British pound relative to its hedge ratio of other currencies and in quarters around the Brexit referendum. And what we see is that the hedge ratio on British pound spiked or increased quite significantly. So here the scale is fractional. So 0.1 is really 10 percentage point increase in hedge ratio. So there's a 10 percentage point to 20 percentage point increase in funds hedge ratio of British pound relative to other currencies in the same portfolio, right? And I should also note that although this increase in hedge ratio seems to take place only after the Brexit referendum, the referendum took place on June 23rd. The snapshot was taken June 30th. And given that those forward contract has like 1 to 2 months maturity date, most of the contract could be entered before the Brexit referendum. So that just showcased that forward contract being a useful tool for mutual fund in managing their exposure when high uncertainty event took place.
Qifei, and
Yes.
Lucas had a point. He said it would be interesting to extend the timeline by more quarters on both sides. You see, so sort of the long or intermediate term effect on the British pound.
Mm-hmm. Okay. Yep. Right. Yeah, that's we'll do that. Okay. So the last part of the presentation is about fund performance, right? And we see in the first slide that during a long period of time, looking at the Barclay index, seems like hedging out currency exposure will not affect the average return, but will reduce the volatility of portfolio significantly. We want to see whether in our sample period and using actual mutual fund data, what the return implication or performance implication of currency hedging looks like. So to do that, we sort fund into 5 quintile portfolios, whereas portfolio 1 is the group of funds with the lowest average exposure to foreign currencies. So that's taking into account both the denomination of assets and the amount of currency forward it sells, right? So if you see the first row, the lowest group have almost exactly zero exposure to foreign currencies. So you should think of those funds as those fully hedged funds. Whereas group 5 is the group of funds that have the highest average exposure to foreign currencies, and that average number is about 100%. So all of this currency, it's exposed to foreign currencies 100%, right? In our sample period, which is 2010 to 2018, the average monthly return for portfolio A is 26 basis points. The average monthly return for portfolio 5, the highest exposure group, is less than 4 basis points. So it turns out in the specific sample period, those hedged funds vastly outperform unhedged funds in terms of average return. Okay, this is very much have everything to do with the exposed realization of USD dollars against foreign currencies. I mean, ex ante, you should expect the currency return should contribute roughly to 0 expected return. Okay, if we look at standard deviation, which is the 3rd row, then the lowest exposure fund, the fully hedged fund, have a 1.18 percentage point monthly standard deviation. The highest exposure fund, the unhedged fund, have a 2.58 percentage point standard deviation. So similar to the index result, the standard deviation is cut, in this case, by more than half, right? So if you take the higher average return and much lower standard deviation, it's no surprise that annualized Sharpe ratio is much, much higher for the low exposure fund than for the high exposure fund, notwithstanding this particular sample period where USD dollar have appreciated. Right? So if you look at this graph, the solid line, the top curve, that's the cumulative return of the group 1 fund, basically, the lowest exposure fund. The circle line is the cumulative return of the highest exposure fund, the unhedged fund. And the lower figure, the bottom line, is what we call dollar risk factor from Hannah Lustig paper. It's really just the average foreign currency return against US dollars. So you see the divergence of high and low exposure funds took place around 2013, and that was roughly the time period starting from which foreign currencies depreciated on average against US dollars. So that's the caution we want to place in interpreting our result, because this is a time period where US dollar have done extraordinarily well against foreign currencies. So let's do some additional work to try to separate out the return of funds into the component driven by the currency exposure and the component that's everything else, right? Perhaps that's the security selection ability, let's say, of those mutual funds. It could be that this difference is entirely driven by realized currency returns between high and low exposure funds. It could be that the high exposure fund actually have better ability in selecting securities. It's just that the currency difference is so large that it actually dwarf the difference in security selection. So that's why we're going to do certain type of return decomposition and see how each component go for high and low exposure funds. So there are mainly 2 ways at least we have done to decompose the return. The first way is sort of the return gap kind of decomposition that Clemens have done 15 years ago, right? So we can take the currency exposure of each fund at the previous quarter end, and then we assume that that exposure stays constant, or more precisely, it will drift with currency returns, but there's no active adjustment, right? So we take the currency exposure from last quarter end, We multiply that by currency returns of each individual currencies, and we sum everything up to the fund level. So that will be what we call the currency implied return at each fund quarter or at each fund month in this case. And the difference between the reported return of fund and this currency implied return will be this currency return gap, or we call currency adjusted return. Okay, so that's one way using portfolio holding information to decompose return into a currency component and a currency adjusted component. Another way is using factor models. And this is in the bottom, the model 2 we're using, right? We can use a factor model, regress fund returns on market returns, global market return, emerging market return, on term premium, credit premium, and most importantly, this Rx, which is the dollar risk factor, which is the average foreign currency return against US dollars. Okay, and then we also have a carry factor. So in this specification, this factor model, we also adjust each fund's average exposure to foreign currencies. Okay, the difference between this factor model against the first holding-based measure is that this factor model imposes a constant loading on foreign currencies, not as flexible as the holding-based model, which we can update the exposure information every quarter. Okay, so if we do this decomposition and we revisit the return difference of group 1, which is the fully hedged fund, and group 5, which is the entirely unhedged fund, we find that currency return is -4 basis points for the hedged group and -25 basis points for the unhedged high foreign currency exposure group. Okay, remember this is a period when US dollars appreciated, meaning foreign currencies depreciated. So this currency return part is negative for everyone, but so much more negative for the high exposure funds, the unhedged funds. So much so that the return difference between the high and low group is 21 basis points. It's highly significant, and that's the chunk that's almost 100% of the return difference between the low and high group. If we instead look at the currency adjusted return, then you see the high and low group have basically the same currency adjusted return. The difference is about 3 basis points. But again, this is also informative. That tells us if you think about the currency adjusted return as sort of the security selection ability or other type of mutual fund manager ability unrelated to currency timing or currency macroeconomic point of view, that tells you that even for the fully hedged fund, sure, they have wind under their sails during this time period. They have a higher currency return, but they definitely do not have inferior security selection skill or other type of skill, right? So that's the currency adjusted return. If we look at our model, factor model adjustment, right? The beta here sort of is consistent with the exposure. The beta is almost 0 for the fully hedged fund. The beta is a little bit above 1 for the unhedged fund. Then you see alpha 2 is higher, or is 3.5 basis points for hedge fund and -10 basis points for unhedged funds. So the difference in alpha 2 is 14 basis points. So it's slightly lower than the difference in raw returns, but it's still significantly higher for hedge fund versus unhedged fund. So if you take that as the currency adjustment method, then it still indicates that hedge fund seems to have even better performance than unhedged fund in our sample period.
Qifei, 1 last minute.
Yes. Okay. Sure. I'll conclude very soon.
Thank you.
And we do this also using calendar portfolio approach. It seems like looking at the raw return, the different components of returns, and factor adjusted return. In some specifications, hedge funds tend to have significantly better performance than unhedged funds. In other specifications, the difference is still positive. Well, the sign is positive, but we cannot sign that because they're statistically insignificant. But it's fairly safe to say that a fund that hedge their current foreign currency exposures do not exhibit inferior return during our sample period. So let me conclude. In this paper, we put together a large and novel data set of US-based international fixed income funds, their holdings currency denomination plus the currency derivatives they use. We find that vast majority of them use currency derivatives, mainly currency forwards, and the use of currency forwards varies significantly across different funds. We further explore the determinants or drivers of those foreign currency derivative strategy. We find currency exposure, risk management, and return enhancement both play some role in determining funds strategy in currency hedging. And finally, we look at the performance implication of currency hedging and find that at least during our sample period, funds that hedge their currency exposure expect both lower return and better or at least same type of level of average return than funds that do not hedge their currency exposure. Okay, so I'll stop here. Thank you very much for all the comments.
Thank you very much, Qifei. That was a very interesting paper, and I will stop the recording